Have you ever wondered how to use pivot points to trade breakouts effectively? Well, you're not alone. The world of Forex trading is filled with fascinating strategies, and one of the most intriguing ones involves pivot points and trading breakouts. This method, though seemingly complex, can be a game changer once fully understood. For the uninitiated, pivot points are indicators used by traders to determine potential support and resistance levels. They play a significant role in predicting market movement. Meanwhile, trading breakouts refers to a strategy where traders enter a long position after a security price breaks above resistance, or a short position when it breaks below support. Imagine the power of combining these two, the clarity it could bring to your trading decisions, and the potential profits it could yield. Intrigued? Stick around to uncover the step-by-step process of using pivot points to trade breakouts. Prepare to elevate your trading game. To start with, let's delve into understanding what pivot points are. In the world of Forex trading, pivot points are significant price levels traders use to determine strategic places for transactions to occur. They are calculated using the high, low, and closing prices of the previous trading day. A pivot point and its associated support and resistance levels are often turning points for the direction of price movement in a market. Pivot points serve as a predictive indicator and denote levels in which the sentiment of the market could change from a bullish to bearish trend or vice versa. In other words, on a typical day, traders would expect the price to reach the pivot point level and then reverse direction. However, if the market is particularly strong, it could go past the pivot point and continue upward to the resistance levels. Now, you might wonder why pivot points are so crucial for traders. One of the key reasons is because they are universally used. Many traders keep an eye on the same charts, implementing the same mathematics, leading to a concentration of buying and selling at these pivotal points. This makes pivot points an easy-to-use tool that gives traders a clear, specific edge in the market. Moreover, pivot points are versatile. They work in all markets and have been used for decades in equity, futures, and now Forex markets. They are also handy for short-term traders who are looking to take advantage of small price movements. Furthermore, pivot points are objective. Since they are calculated using a standard method, all traders will get the same result and see the same levels. This makes trading decisions more black and white and less subjective. Finally, pivot points offer a way to see potential market reversals, breakout plays, and if the market is drifting sideways, they help traders to spot key levels that need to be broken for a move to qualify as a breakout. That's the basic understanding of pivot points, a crucial stepping stone to trade breakouts. Now that we understand pivot points, let's explore the world of trading breakouts. Breakouts occur when the price of a financial asset, such as a currency pair, moves beyond a defined support or resistance level with increased volume. This could indicate the start of a new trend or the continuation of an existing trend, offering lucrative opportunities for traders. There are two main strategies for trading breakouts. First, the aggressive way, which involves entering a trade as soon as the price breaks through a pivot point. This approach can yield significant profits if the breakout is real, but it also carries the risk of false breakouts, where the price breaks a pivot point but does not continue in the expected direction. The second strategy is the safe way, which involves waiting for the price to retest the breached pivot point before entering a trade. This method can help protect against false breakouts, but the trade-off is that you might miss out on some of the initial move. Both strategies have their merits and drawbacks, so it's essential to choose a method that aligns with your risk tolerance and trading style. Trading breakouts isn't without its risks, though. One of the main challenges is the uncertainty of whether the price will continue to move in the breakout direction. You might enter a trade expecting the price to rise, only to find that you've bought at the top of the market. Moreover, market volatility due to economic news releases can trigger wild price swings, leading to potential false breakouts. Another risk is overlooking other key support and resistance levels. For instance, you may think that a price is breaking through a resistance level, but fail to spot another strong resistance level just above. To mitigate these risks, it's crucial to stay up to date with economic news, carefully watch price movements, and be aware of key support and resistance levels in the market. Trading breakouts can be risky, but with the right tools and understanding, it can be a game changer. Let's dive into the step-by-step process of using pivot points to trade breakouts. Firstly, you need to accurately identify the pivot points. These points are typically calculated based on the high, low, and closing prices from a previous trading session. In essence, pivot points serve as potential support and resistance levels, and their intersection could indicate possible price reversals. Once you've identified these pivot points, the next step is to recognize potential breakouts. A breakout occurs when the price moves above a resistance level or below a support level. Keep an eye on the market's behavior around these pivot points. If the price levels start moving beyond these points, you could be witnessing the early stages of a potential breakout. Now, when it comes to trading breakouts using pivot points, you have two primary approaches to choose from: the aggressive way or the safe way. The aggressive approach involves entering a trade as soon as the price breaks through a pivot point. This method can be exciting as you're riding the wave from the very start. However, it does come with its risks. Sometimes what appears to be a breakout might just be a false alarm, and the price could reverse its course. On the other hand, the safe approach recommends waiting for the price to retest the breached pivot point before entering the trade. This method allows you to confirm the breakout, reducing the chances of getting caught in a false breakout. However, the trade-off is that you might miss out on some part of the initial move. Let's illustrate this with a hypothetical example. Suppose you're trading the EUR-USD currency pair, and you've identified a pivot point at 1.20. As the trading session progresses, the price starts to inch closer to this level. Suddenly, there's a surge, and the price breaks above the pivot point, signaling a potential breakout. If you're an aggressive trader, you would enter a long position right away, hoping to profit from the upward trend. However, if you're a more cautious trader, you'd wait for the price to retest the pivot point before entering the trade. If the price bounces back from the pivot point and continues its upward movement, you then enter a long position, confident that it's a genuine breakout. Finally, regardless of the approach you choose, managing your risks is essential. This involves setting a stop-loss order to limit your potential losses if the market moves against your expectations. For instance, if you've entered a long position after a breakout above a pivot point, you could set your stop-loss order just below this level. This way, if the price reverses and falls below the pivot point, your trade would automatically close, limiting your losses. Remember, while pivot points can be a powerful tool for identifying potential breakouts, they're not foolproof. Market conditions can change rapidly, and unexpected news events can cause sudden price swings. Therefore, it's crucial to stay informed about market news and economic events, and always be prepared to adjust your strategy as needed. So, that's how you can use pivot points to trade breakouts, a technique that could potentially enhance your trading strategy. Before we wrap up, let's summarize the key points we've discussed today. We started by unveiling the concept of pivot points, a powerful tool in the world of forex trading that helps identify potential support and resistance levels. It's important to remember that pivot points don't always hold, and it's necessary to have other tools in your toolbox ready for those instances. Next, we delved into the concept of trading breakouts, an aggressive yet rewarding trading strategy. We explored the two main ways to trade breakouts, the aggressive way and the safe way. The aggressive method involves jumping in at the initial move, while the safe way requires waiting for a retest of support or resistance. Both methods have their merits and risks, and it's crucial to choose the one that best suits your risk tolerance and trading style. The meat of our discussion was using pivot points to trade breakouts. We used a real-world example to demonstrate how pivot points can indicate potential breakout trades. We saw how price movements around the pivot point and the R1 and R2 levels can signal breakout opportunities. It's crucial to remember that just because a price breaks a pivot point or resistance level, it doesn't guarantee that the price will continue in that direction. Sometimes the price may reverse, leading to what's known as a fake-out. We also touched on the importance of keeping an eye on the news and economic calendar, as volatility spikes during news events can cause wild price movements. And remember, it's always a good idea to mark other key support and resistance levels on your chart to get a complete picture of the market. Remember, trading is a skill, and like any skill, it takes practice to perfect. Keep these points in mind and keep practicing. We've come to the end of this journey on how to use pivot points to trade breakouts. We've traveled through the landscapes of understanding pivot points, trading breakouts, and the nitty-gritty of using pivot points to trade these breakouts. It's been an exciting ride, hasn't it? Now it's time to put this knowledge into action. The financial market, with its dynamic nature, offers a vast playground to apply these techniques. Remember, pivot points are not just theoretical constructs, but practical tools that can help you identify potential breakout points and make informed trading decisions. However, don't forget that no technique is foolproof. There will be times when the market behaves unpredictably. That's where your resilience as a trader comes in. Don't be disheartened by initial hiccups or setbacks. Instead, use them as stepping stones to refine your strategies and keep perfecting your use of pivot points. Like any other skill, mastery over pivot points and breakout trading will come with practice. So, don't hesitate to dive into the market, experiment with your strategies, and learn from your experiences. The more you practice, the more adept you'll become at spotting potential breakouts and making profitable trades. Moreover, never stop learning. The world of trading is ever evolving, and there's always something new to learn. Keep exploring different strategies, keep up with the latest trends, and never let your thirst for knowledge dry up. In the world of trading, remember, knowledge truly is power. The more you know, the better your trading decisions will be. So arm yourself with knowledge, keep refining your strategies, and let your trading skills soar. As we wrap up this video, I encourage you to revisit the key points we've discussed, practice using pivot points in your trading, and continue your journey of learning. Remember, in trading, knowledge is power. Keep learning, keep trading, and see you in the next video.